2023 proved to be a year of market uncertainties, with inflation, rising interest rates, and geopolitical tensions roiling investor confidence. As we navigate the uncharted waters of 2024, selecting the right exchange-traded funds (ETFs) to diversify your portfolio and manage risk becomes paramount. In this article, we'll delve into 5 promising ETFs across diverse sectors and asset classes, analyzing their potential and helping you chart a course for financial success in the year ahead. 1. iShares Global Clean Energy UCITS ETF, INRG, riding the green wave. The push towards renewable energy sources is gaining momentum, driven by climate change concerns, government policies, and technological advancements. INRG captures this dynamic, tracking the S&P Global Clean Energy Index. It provides exposure to leading companies across the solar, wind, hydropower, and alternative energy sectors. With global clean energy investments expected to reach $2 trillion by 2025, INRG offers a chance to tap into a potentially high-growth segment while contributing to a sustainable future. Key advantages. High growth potential. The clean energy sector is projected to be one of the fastest-growing industries in the coming years, offering potentially significant returns. Diversification. INRG provides exposure to a diversified basket of clean energy companies, mitigating the risk associated with individual companies. ESG alignment. Investing in INRG aligns with environmental, social, and governance (ESG) principles, attracting environmentally conscious investors. Potential risks. Policy dependence. Regulatory changes and government subsidies play a significant role in the clean energy sector's growth, introducing policy risk. Commodity price fluctuations. Fluctuations in the prices of commodities like oil and gas can impact the performance of some clean energy companies. 2. Vanguard Information Technology ETF, VTI, embracing tech titans. The information technology, IT, sector remains a cornerstone of the modern economy, driving innovation and shaping our daily lives. VTI tracks the performance of the Vanguard Total Stock Market Index, providing exposure to approximately 4,000 U.S. companies, with a significant allocation to IT giants like Apple, Microsoft, and Alphabet. As technological advancements continue to reshape industries and disrupt traditional models, VTI offers a diversified entry point into this dynamic sector. Key advantages. Broad exposure. VTI provides access to a wide range of companies across various IT subsectors, minimizing single-stock risk. Long-term growth. The IT sector has historically driven market growth, making VTI a suitable option for long-term investors. Liquidity and cost efficiency. VTI boasts high liquidity and a low expense ratio, making it a cost-effective way to gain broad IT exposure. Potential risks. Valuation concerns. Some argue that certain IT stocks are overvalued, raising the risk of corrections or slower growth. Regulatory headwinds. Increased regulatory scrutiny of tech companies could hamper their growth potential. 3. SPDR Gold Shares, GLD, hedging against volatility. Gold has long been considered a safe haven asset, a valuable hedge against market downturns and economic uncertainty. GLD tracks the price of gold bullion, offering investors a convenient way to gain exposure to this precious metal. In times of market volatility, gold tends to hold its value or even appreciate, providing much-needed portfolio stability. With inflation and geopolitical tensions remaining on the radar, GLD could serve as a valuable protective tool in 2024. Key advantages. Safe haven asset. Gold's historical performance during market turmoil makes it a valuable tool for risk mitigation. Portfolio diversification. GLD adds a unique asset class to your portfolio, reducing correlation with traditional stocks and bonds. Inflation hedge. Gold tends to hold its value in inflationary environments, protecting your purchasing power. Potential risks. Limited returns. Unlike stocks, gold generally does not generate dividends or interest, relying solely on price appreciation for returns. Market fluctuations. While considered a safe haven, gold prices can still experience short-term volatility. For Vanguard Emerging Markets ETF, VWO, unlocking frontier potential. Emerging markets, characterized by rapid economic growth and rising consumer spending, present significant investment opportunities. VWO tracks the FTSE Emerging Markets All-Cap China A Inclusion Index, providing exposure to companies across sectors like financials, consumer staples, and technology. While emerging markets carry higher risk, their long-term growth potential can be attractive for investors with a higher risk tolerance. Key advantages. High growth potential. Emerging markets have the potential to outpace developed markets in terms of economic growth and corporate earnings. Diversification. VWO offers exposure to a geographically diverse array of companies, reducing reliance on any single market. 5. SPDR, Bloomberg Barclays High Yield Bond ETF, HYG, seeking income in uncertain times. As interest rates rise, fixed income investors face the challenge of finding attractive yields. HYG tracks the Bloomberg Barclays High Yield Bond Index, providing exposure to bonds issued by corporations with lower credit ratings. While higher risk, these bonds typically offer higher yields than investment-grade bonds. In an environment of rising rates, HYG could be a source of income for investors seeking to offset potential losses in other parts of their portfolio. Key advantages. Higher yields. High-yield bonds offer significantly higher yields compared to investment-grade bonds, potentially boosting portfolio income. Inflation hedge. While interest rate risk exists, high-yield bonds can provide some protection against inflation due to their potential for increased coupon payments. Diversification. HYG adds diversification to fixed income portfolios, reducing dependence on government bonds. Potential risks. Credit risk. High-yield bonds carry higher default risk compared to investment-grade bonds, potentially leading to losses if issuers fail to meet their obligations. Interest rate risk. Rising interest rates can lead to price declines in high-yield bonds, amplifying potential losses. Conclusion. Navigating the complexities of the 2024 market necessitates diversification and strategic ETF selection. The 5 ETFs highlighted here offer exposure to diverse sectors and asset classes, catering to various risk appetites and investment goals. While no single ETF guarantees success, understanding their potential and risks enables informed portfolio construction and long-term growth. Remember, conducting thorough research, seeking professional advice, and continuously monitoring your portfolio remain crucial for achieving financial success in an ever-evolving market environment.